and I would now like to introduce you to our two co-presenters, David Lehman with K&L Gates, who is one of our top regional startup lawyers and maybe even beyond regional, and Adam Kelson, who is also with K&L Gates, who is going to be the other side of the table of the negotiation. Also with, did I say K&L Gates? Okay, David, you're on.
Well, thank you. Thank you, Kit, and thank you everybody for joining us this evening. We're going to talk today about convertible debt, which is one means by which people raise capital. One of the vehicles that you can offer preferred stock, convertible debt, and we'll talk a little bit more about that. So, what we're going to do is the following. I'll talk a little bit about negotiating just generally and some negotiating points, because that's not something we cover elsewhere in the Start Smart series, and we thought it'd be helpful for people just to sort of spend a little bit of time just talking about how one negotiates and approaches negotiation. And then we'll go through the term sheet that would be negotiated, and I'll just run through it sort of on a just quickly so we all understand the terms that are in it, and run through the term sheet. Then we'll split into groups, and the folks that end up in my room will represent the company that's going to get the money, hopefully. And Adam will be in the other room, he will be the angel investor, and so they will be gathering up and figure out their strategy. Then we'll come back together for a mock negotiation. So that's a lot in a little bit, but I think we can accomplish it pretty well. Any questions before we get started?
So I'm just
Adam,
asking just to put the two documents you sent me this morning in chat. And if you can,
okay.
No, okay.
Actually, what I'll do is I'll share my screen maybe with the tips to start with. Adam, anything you want to add before I get started?
No, I think that's a great summary and ready to go.
Okay. So if I did it right, there should be the negotiating tips and not my notes from my last call with clients.
Yeah.
So good. So just running through it, and there's not a lot here, but I think it's worthwhile because I do think there's a art to negotiating, and it's not just about getting to yes. As I told my son, sometimes a bad deal is not, no deal is better than a bad deal, and there are tricks to it. So one is not to rush. I mean, my experience with negotiating deals is sometimes it takes time. Sometimes it takes more than one session. And if you try to push it too hard, you might end up with a result that you really don't want. So I tend to take a deep breath when I'm talking to people when negotiating, let people sort of let it rest a little bit, walk through it. This is balanced against the old saw that says time kills deals. So you can't let it go too long because people lose enthusiasm and they get what's called deal fatigue. But on the other hand, you got to let it play out a little bit. And so negotiating of deals has sort of a rhythm, and you got to go with the rhythm and not rush it. Number two is one of my mantras, and I can't emphasize it enough, which is to listen. Listen to both to what the other side is saying. As long as the other side is talking. I learned this actually. I've always thought it, but it really came home to me when I was with my litigator pals negotiating a deal not too long ago, a few years ago. And litigators are trained to talk, because while they're talking, two things are happening. One is the judge or whatever may be listening and actually convinced of what they're saying. And the other is that the other side isn't talking. And so they try to keep the mic in front of them as much as they possibly can. My view when negotiating is exactly the opposite. I prefer the other side talk as much as they possibly can, because one of two things is happening. I'm learning about what they're thinking, because the more they're talking, the more I'm learning about what their position is, what their concerns are. And frankly, sometimes they'll talk themselves right into conceding, because sometimes when you negotiate, it's just an opportunity for the other side to get together and talk amongst themselves. And so let them talk it out. I mean, sometimes I want to rebut points and things, but it's just good to listen to what they're saying. This is not, negotiating really isn't about getting one over on other people. And I find at the end of the day, if you really understand what people's concerns are, you're not posturing, but you really try to get what they're at, then you can get to the bottom, what their concern is. I mean, you're going to hear today some stuff about, as an example, things about, for example, investing principal stock. Well, what's their real concern behind that, and how can we address it? I mean, and that's just, if you get at the heart and listen to people, I think you'll get there pretty well. Number 3 is one of my favorites, which is that, and this is also a litigator's point, but move on when you win the point. I have seen people talk other people out of having conceded. It's an incredible talent. Not everybody has that talent. When somebody says, I agree, you win, you politely say thank you, and you move on to the next point. Do not stay on that point, because I've seen people lose. Number 4 is prepare, prepare, and prepare. And when you're done, maybe prepare a little more. There's nothing like, for example, we're going to negotiate a term sheet today. In preparation for that, I would have spent some time reading that term sheet. I would spend time with my client going over that term sheet. I would go over what their objectives are, what the other side's objectives are, what our alternatives are. I mean, we spend a lot of time thinking about that before you go into a negotiation. And the more you prepare for it, the better off you are. Number 5 was communicating among yourselves, and as importantly, to have a system to talk about. There's usually more than one person on one side. Usually I'm there as counsel with a client. And so I have a couple rules, one of which is, even less in today's world of COVID, but generally, I prefer to be in the same room as my client when we negotiate, so that we can sort of communicate, whether it's hand signals or just wink at each other and go into another room. Find some way to communicate. I really don't care where the other side is, but I want to make sure that I can communicate with my team. I mean, it may be if we have to be separate places, have a system set up where you can go on hold and talk by a cell phone off to the side. But it's important to talk amongst yourselves, and feel free to do that. Excuse yourselves. I mean, I don't know you, but it's not atypical during negotiation for me to say, okay, good time for us to pause. I'm going to go in another room and talk to my client, and sort of take a pause there. So, when negotiating, I think it's essential that you understand sort of where you are, what your choices are, and what you think the other side's choices are. If you have alternatives, understand what they are. A few years ago, there was a VC around town that was doing, because of the market, some pretty harsh terms. And I had 3 clients negotiating with the same VC with fundamentally the same harsh terms. And one client did not take it, took a strategic investment from an out-of-town company and did just fine. One said, well, the heck with this, there's too much dilution, I don't love this, and they sold the company and did just fine. And another one who said, you know what, I don't really have a choice, they took that deal, that didn't work out so well. So consider your alternatives, and frankly, create alternatives. Try to when you're negotiating, try to create as many alternatives for yourself as you possibly can, so you have choices when you're negotiating, because that's really critical. My number 7 is a little odd, but taking into account personalities. Different people are different ways. Some people like small talk, some people don't. Some people get, I've negotiated, and I realized in the first round that the guy got more difficult as the day wore on, because it got kind of tired. So in that case, the idea was to get the important stuff out front, because while you still had his attention, he wasn't kind of cranky. Other people like to sort of warm up, so you start with easy stuff first, and then you get to the harder stuff later. So the extent that you can get insight into the other side, and frankly, your client and you, I think that helps the negotiation. That sounds kind of silly, because it should all be about substance, but it's not. So you have to take into account personalities. Driving the process structure is really important. People always say, take drafting opportunity. If you can draft, that's better, because for everything you put in there, the other side will only get about 10% of it. But if you can't do that, I mean, I always do agendas for meetings or calls, because that way I can sort of structure the conversation. If I can't do that, and redrafting, I'll do an issue list to talk about, so I can then structure this conversation that way. But taking taking control of the negotiation through one of these ways is important as well. Number 9 is pretty intuitive, which is make sure you have the right people. I mean, it's the classic negotiating a car. Where they got to bring the manager in, and so just make sure that people with the decision making are either in the room or you understand the process, so that there's going to be renegotiated. So at least you understand the process. And the last one is don't fight for the last crumb. This is not about winning. This is not about losing. This truly is getting a deal that you're comfortable with, and the other side is okay as well. So. And usually if it's a business deal, there's going to be a life together afterward. So you want to make it a deal that everybody's comfortable with, and there's not a huge amount of bitterness at the end of the day. So, if it's a couple points or a couple dollars or something at the end of the day, that's not really what's critical. The critical deal is getting somewhere that you're comfortable with. And frankly, there's life after this deal. At least in Pittsburgh and other places as well, the world's just not that small, not that big. So you want to make sure that you have the only people bitter, and so and I'm not saying give stuff up. I'm just saying you have to fight for every nickel on the table. I went through that quick, but sort of I want to get those out of the way. Adam, anything you want to add to that, or elaborate on, or complain about?
I think the only thing I'd really add is that everyone has to find their own style, and so what works for David and what works for me may not be exactly what works for you as when you're negotiating. And so it's important, the fundamentals that David is saying here are absolutely true, but people have different levels of comfort in different styles, and so you just have to really figure out what works for you, recognizing that there are some basics that you want to keep in mind. So
yeah, I agree with that. I don't think I know Adam is, and I'm not. We're not table pounders, but they're out there. I don't find it a very effective style. It relatively puts me off, but people do it. So you got to find what works for you. I agree with that. Questions? Okay. With that, let me. Take a moment and go through the term sheet for a moment. Cool. Can you all see the term sheet? Presumably yes, huh? All right. So this is for a company called Ingenious. It was originally designed about we joke about it being sort of a software company for bowling, of all things, created by two guys, Tim Stryker and Tom Ryder. Tim being sort of the guy whose idea it was, and Tom being the software guy. And this is about keeping track of scores and all that kind of stuff for bowling leagues, but it can have lots of applications, and they've done a nice little business. They developed it along the way, and but they need some working capital. So they've gone to the market to get some equity or some investment, and they've come across this angel network that led by, of all people, Adam Kelson, who happens to be on the phone, and they've decided to go the route of convertible debt. Now, as we talked about the last time we were together, or we did one of these, we can do a priced round. You can do other things, but at this stage, for your first round, sometimes convertible debt's pretty good. So we think that's actually a pretty good route. So I'm just going to run through the term sheet that we have and run through what the terms mean, and then we'll break into the group. You'll see that it can be used. They're going to invest about $250,000. It will be used to fund the further development and commercialization of the product. This says this note will accrue interest at 10% per year, a simple interest, and it will convert. That interest will convert into equity upon conversion conversion of the note. It matures about a year from now on December 31st, and it converts to equity, and that's the magic of convertible debt. It converts at the next round, and this is defined as a round of financing of at least $1 million, a priced round. It converts at a discount, you'll see, of 30%, 0.7, which is a 30% discount to the next round. So when we raise additional capital of at least $1 million, and the VC or somebody comes in and invests that, this note of what's called $250,000 plus interest will convert to the equity, the Series A, if that's what it is, at a discount to 30% discount. So if it's $1 per share, they'll pay 70 cents a share for having and get interest at 10% for having come in earlier and taking more risk. This also has what's called a cap of $2 million, which says that, you'll see here, an evaluation cap, which means that even if the next round comes in a much higher number, call it $10 million or $6 million, the maximum amount of the value that's permitted on this is $2 million. So obviously that means that the conversion of this note will yield more equity than it would if they converted at a higher price, call it whatever that would be, $10 million. And to give you some, I'm not going to do all the math, but to give you some sense of it, if there were, it was a 1 year and it were, so then the amount converted would be $275,000, $200,000 plus 10%, which is $275,000. And we're a $6 million valuation at a 30% discount. That would yield about 6.5% of the company, putting aside just to give you some sense of it. At a $2 million valuation, it would yield about 12% of the company. So the difference, so the cap can have a significant economic effect on the principals, depending on what that is. So that's that piece. I suspect there might be some discussion over that. If there's a sale of the company, a significant transaction is really just a fancy word for a sale of the company. This term sheet says that the note will convert at what do we have here actually? The amount that it would be, the value of the deal of the sale at a discount with a cap, or they can get, or the investor can get 2 times its investment. The note holder can get 2 times the investment plus interest. So it has a choice as to which way it wants to go. It says it can't be prepaid. So and that's because a note holder is doing this convertible debt for the opportunity to convert, because nobody wants just the interest; they want the potential upside. So if this were Google and they had just gotten their first $250,000, somebody would feel really bad getting only 10% of the money and not having an opportunity to convert into it and getting the benefit of the upside. So that's why it says it may not be prepaid. I'll skip this. They will have a right to have 1 member on the board, and that stops upon the sale of the company. But they have a note holder on the board. Second, it provides that each of the founders, Tim and Tom, they vest their stock over 4 years. And so they basically take the stock that they own and it will vest over 4 years to protect the investor from them leaving and therefore taking all the equity. So they now have key employees key owners who no longer have anything with the company. So this term sheet provides that they'll have 4-year vesting. What did I do? I went too far, huh? What's that? There it is. 4-year vesting. And they'll assign, and they also signed non-competes for the company for 3 years. Actually, for the term of the employment plus 3 years with no severance. You'll see that they can be amended with all the note holders' consent, and a shareholder agreement and exclusivity. investors don't love it when you take the term sheet and you start negotiating with others because they're going to do the due diligence. They're going to spend money doing this. So this says until July 31, the company can't negotiate with anybody else to raise capital. It also says that I skipped one, expenses, that the company will pay the legal fees regardless of whether the transaction closes. So if we sign this deal, this term sheet, and the investor incurs some legal fees, the company has to pay those legal fees. Hopefully I did that summary in a fairly middle of the road just way. Adam,
you didn't tip your hand at all, David.
I didn't, not at all, huh? Not once. All right, Adam, anything you want to add to that summary?
No, I mean, I think David kind of went through each of the points. There's going to be a push-pull, right? Certain things, you're going to want to, you may move in one section and have to give it another. And I think that's the point of this exercise here, is to try and find a place where everyone can be happy. And there are definitely certain provisions that correlate to each other, that they're really specifically about the economics. So that's the conversion rate, the cap, the interest. Those are very fundamental economic points in a convertible note deal. And as those things move, they kind of move in concert. But really, other than that, I think the rest are things you try to put in separate bucket, I guess.
If I could, David, one of the things I would throw out there is, one of the reasons you consider convertible notes versus a priced round is, in many cases, early stage companies don't have enough information to really come up with a smart valuation. So a convertible note basically kicks the can down the road on that harder valuation question. And basically the agreement is that the money that's put in will convert at a future date based on a later valuation of the business.
Yep.
So, strategic reason for choosing a convertible note versus a priced round.
And indeed, if you did, I totally agree. And indeed, if you were to value it at this stage, it might be valued at a significantly lower valuation that would be unattractive and unduly dilutive to the company, to the founders. So if you value the company today, and it's worth at $1 million, for example, and you gave up and you took $250,000, the investors would have 20% of the company. If, on the other hand, it goes at you now wait and give them a discount to a $5 million valuation, the investors will get much less of the company. So I agree with you. It's difficult to value, and if you're going to value, it may be disappointing. So the valuation.
The other thing to think about there is that arguably a note investment is an easier transaction to close from a legal perspective. So typically when you're doing a price round, it's a little bit more involved in the negotiation. There are more documents to execute and more points to negotiate. So part of in addition to kicking the can down the road on valuation to a point, obviously with the cap, you are settling in on the high end, but is that you can get to a close, you can get the money funded more quickly. So not always true, but most of the time I'd say that's the case.
I agree with that. Okay. Questions before we break into rooms? One of the other things, by the way, we'll do in the rooms is select a client. Somebody has to be a spokesperson for beside the lawyers, because the lawyers shouldn't be the leading it. We only give advice. So somebody else has to actually call the shots. And so we will appoint a client when we get into the room, client or two.
So we asked Jess to just arbitrarily put you in one room or the other. I mean, what you're going to hear is the other side. And when we get back into the negotiation, you will hear the other side as well. So don't worry about which room you're in. So it's just going to be very arbitrary.
How long would you like the breakout rooms to last for?
We can set a
Uh,
time and then we'll see what happens, but go ahead.
I don't know, what do you think? Maybe like 20 minutes?
I think
Ish.
that's good. Yeah.
All right.
Okay, so Jess, before you just arbitrarily throw everybody back in, go in and check. Okay,
Oh, yes. I will jump in and make sure everybody's good to go.
Kid is skeptical of my 20-minute estimate.
So,
yes. Well,
Other than the term sheet, what do we know about the business? Are there any financials or any other information to help determine the negotiation strategy?
Not much. I mean, it's not, they don't have any debt, by the way. And right now it's only the two of them that are employed by the company.
Is it pre-revenue?
It's just a smidgen revenue. Maybe a couple $1,000s, very, very low. Enough that they have proven the concept and proven that there's people willing to pay for it, but not enough to actually commercialize it yet.
Okay. They're
So they
almost
have-
out of cash, right, David? If they don't take this deal very soon, they'll probably fold.
No, because Mr. Ryder's dad turns out to have some money, but he preferred that he get it from a third party.
Just checking.
Definitely not Mr. Ryder's wife.
Yes, right. Yes. Yes. Or neighbor. Yes. All right. Ready to break? All right. We're back. I don't see. Where's oh, there's Adam. Hey, Adam.
You know, keep moving around.
You do. It's not useful. I'm going like this. So first I want to introduce you to Anthony and Veronica, who were playing, who actually for this purpose are Tim and Tom. So wave or something so they can see who you are. Heads up. I got one smile. Heads up.
I don't actually know where those buttons are, but hopefully I'm
that's cool.
highlighted in yellow now.
There you go. Cool. So Adam, do you have clients or you're the spokesperson?
And on our side, we're going to be led by Benjamin with support from the entire cast as necessary. Angels will be piping up when the moment strikes.
All right, cool. Strikes being sort of the appropriate pun for this. Cool.
Yeah, I guess.
I guess so. All right. So I don't know. We appreciate your term sheet, and we actually thought that in large part it was a reasonable term sheet. There's a couple of things we do want to talk about though, because and need some tinkering. And with that, I don't know, Anthony, Veronica, which of you would like to sort of start? Would either of you like to start?
Go ahead and start. So I guess one of the first things that we noticed was the cap for this term sheet. I believe it's currently set at 2 million. When we were considering that should go up to 5 million.
All right.
How does that sound to you guys?
We're not sure if 5 million would be a good number for us. We could see maybe moving up a little bit to 3 million, but I don't think 5 million would be on the cards for us.
All right. Well, how about we try splitting that difference between that 3 and 5 and settle on the 4 million?
I think that would still be a little bit too high. Maybe 3 1/4.
How about 3 3/4?
Well, it seems like right in the middle would be 3 1/2.
Yeah, I, I think 3 1/2.
So-
We can sit there for now.
So at one, as one approach, when you find you're sort of zeroing in on it, is to say, okay, let's hold that for a moment and maybe look at some of the other economics, just look at the package. Might be an approach. So so maybe but that's good. So and we did have some other economic issues, right, Anthony?
Yes, we did. So another thing I'd like to discuss is the discount at the end of this. Currently, it's set at 30%. And we were considering that should be changed to about 15%. Any thoughts on that?
As far as 15%, again, I think, we're happier with a number closer to 30%. We could give maybe to 25%.
See, our sense is that, for what it's worth, is that this conversion is not going to take that long, and there's not, there's a bit of a time thing here, and so, as you've already pointed in your term sheet, the maturity date is in about a year-ish, so we only have a year, and so the distance between now and then is not very long, which yields a smaller discount. And we're thinking that even 25% is a little high on the market side of that, for what it's worth. So we'd like to see it come down south of the 25.
And so just to jump in here, I guess, I want to make sure, are we agreed on the cap at 3.5 billion? Is that something that is firm at this point, or is that still open for negotiation as it relates to the cap? Because obviously those two things go together.
They do, and so we heard it's at 3.5, and we wanted to see how the rest of it played out before we put a pin on that one, before we finished up at that point.
Well, I don't want to speak for my client, but I think that if we can get firm at 3.5 for us, that makes it much easier to have a conversation about conversion rate here. So, and we can get closer to 20% on that number if we can be solid on our valuation cap. But again, to kind of deferring to Benjamin on that point.
No, I think that sounds correct.
So can we add, so thank you for that, and Anthony, tell me if I'm wrong, but maybe we want to mix in at this point the interest rate, because the 10%, sort of smells of broken knees. Is there maybe we could bring that down? Pardon? Yes, maybe we could bring that down to a more commercially reasonable rate as well. So we were, and Anthony, we were thinking that as being what?
We were thinking that would be about 5%. Rather than that current 10%.
I think as far as us, we were thinking that I think 5% sounds a little bit low for what we were wanting to get out of this. You do 7.5%.
So maybe. 1 second. So you guys were at a 15% discount? My notes right?
Oh, we were at 25 or 20% discount. Sorry.
20%.
Sorry, I have my notes wrong. So, what would you think about and you said seven and what percent? 7%?
7.5.
Okay. So maybe we can go to a 15 percent discount, a 7%, and keep the cap at 3.5. And I would recommend that to my client.
And just to be clear, you're comfortable with most of the other terms around this, maturity date, other
No, there's other,
significant transaction.
what's that?
The maturity date is actually firm. You're comfortable with the 1-year maturity?
Yeah, because we plan to raise more capital. So there's no question about that, which is why I'm pushing hard for the lower conversion rate.
Fair enough. I mean, so again, sidebar with my client, fictional. I think if we're at a place where we've got a less than 1 year to convert in 15%, it's really probably going to be fine. You're hopefully at the valuation cap that you've negotiated at 3.5 is on the lower end. So I think we can probably get there. As far as the interest rate, it all sounds reasonable to me under those circumstances, or whatever.
And also a theoretical sidebar. In terms of the conversion rate being lowered, that's fine if the conversion takes place within that year. But if it goes beyond the year, maybe there's a second conversion rate that's higher.
Yep. Well, we also right now have a default, so we'd be in a pretty good seat from as a lender. So that's why I was a little surprised they weren't pushing back on maturity date. But we're in the hypothetical sidebar. So
Right.
So just to emphasize this, remember when David said about the tips? This is where he would have said, excuse me for a minute, my client and I, both of you would have kind of gone offline and looked at the thing as a package and sort of figure out where you were going to do the give and take.
Yep.
correct. So Benjamin, back to the negotiating table. What do you think?
All right. Well, it seems like we are at an agreement on those parts.
Well, I said I would recommend it to my client, but I've not heard from them. So let me, clients, what do you think?
So in terms of kind of everything we've talked about, discount of 15%, interest rate of 7.5% with a 3.5 million cap.
Actually, I think I said 7%. I think it was 15%, 7%, and 3.5.
3.5.
Yeah.
Wrote my decimals in the wrong place. So 7%, 3.5, and a 15% cap.
Discount. Yeah.
Discount.
Yep. What do you think?
All right.
All right. Anthony, Veronica, you good with that?
I'm good with that.
Veronica.
You're on mute.
Yeah, I'm good with that.
Cool. Okay. Let's go to do you want to, Veronica, you want to take the second set of issues?
Yeah. So we want to negotiate on the terms of vesting. As it stands right now, we are agreeing to the concept of it. However, we're going to suggest to have a little bit of a different schedule. We're going to propose to have 1/3 immediately vested and then 2/3 vested for a 2 to 3 year period. How does that sound?
We think the 4-year period for the vesting is, something that we want to stick with, but we would be willing to be a little bit flexible with the start date of that vesting, such as the start of when the company was founded, rather than when this deal would close.
Cool. All right. Well, the company was founded 3 years ago. So,
Yeah.
So,
As he changes the facts, lovely. Yeah.
We accept.
Sidebar.
Well, the company was really founded 3 years ago. Your traction is really poor. We really need to go back to the valuation. 3 years later, you're still struggling with these numbers. Maybe we ought to reconsider our investment altogether. There you go.
well, it depends what you mean by started. It was a germ of an idea. Actually, the germ of this idea was about 35 years ago. But that goes. So, all joking aside, why don't we pick rather than the date of the company. As I take the point about the start date. I think we all agree that there's some piece that should be vested promptly. And so we got to figure out what that is, that seems to me. And I don't know, folks, 4 years seems like an awful long time for vesting.
Are your folks planning on going somewhere? Just curious, since you're in control of the company and really with management, obviously that's the big concern.
Well, of course, we are not in control. I mean, presumably we may or may not be in control when we take in the additional money. Who knows how that's going to play out? And so, and obviously, I mean, I'll speak to my clients, but they are committed to this. But things happen in life, and and so things happen. Other opportunities come. Boards fire them. They die. I mean, all kinds of weird things happen. And so, just 4 years is a lifetime. So, I mean, it would be more typical to have I think a shorter time period.
Just an editorial comment from the sideline. The length of vesting is kind of geographically skewed. If you're in the Bay Area where things are very competitive, typically it's around a 2-year time frame for vesting.
Yep.
In Midwest, it's a little bit longer, but I would think 3 years would be a reasonable period of time, with a third of the equity vested up front, with the balance over a 3-year period. I think that's a good Midwestern term.
Sidebar to my group. I agree.
I agree. Anthony?
Yep, I'm on the same page. Just sticking with this 2-year timeline rather than the 4-year timeline. I mean, 3-year timeline. Sorry.
It would be 3. A third.
3. I'm sorry.
And then 3 years for the balance to mature.
So they get 1/3 right away, and then you're saying 3 years for the other 2/3? Is that what, Don,
Right.
are you negotiating for on Adam's side, or are you negotiating on our startup side?
I'm proposing that as a sidebar to the investment team.
Well, wait a minute, let's.
That's Benjamin. So Benjamin, did you just make sure you understand the proposal? So it's a third vested now, and the remaining 2/3 vested over the 3 year.
Over a 3-year period.
Right.
For the other 2/3.
Does anyone else on the investment team have any thoughts on that? No?
It's all in your hands.
Oh. How about a quarter vests immediately, and then the rest over that time period, rather than a third immediately?
The math is easier.
So, I have a calculator, so I'm good with the math. This is actually pretty significant to us. So the difference between 25% and a third is pretty material. And as and I heard through the grapevine that some people even think that the third vested is commercially reasonable. So we're thinking a third vested up front is pretty fair. I mean, it's all joking aside, it's not. It would be really disappointing if we got terminated or something happened and we lost, and the amount of work that these folks have put into this thing, and walk away with only 25% of the stock. So we're thinking a third is a reasonable place to be.
Assuming that we are successful and that the founders would get to the end point of the vesting period, doesn't it all end up in the same place?
Yeah, if it all works out just dandy, but the world doesn't always end up dandy. So we're talking about here is if, for example, they get terminated and what they walk away with, or something happens, they have to leave.
So
Yeah.
as a sidebar for the team investor, I think we're more sympathetic to a situation where they're terminated than we are to where they have to leave. Understanding that things do happen to people in life, but ultimately, what you can control, and as they can control whether or not they leave, and so one other way that we might try and negotiate around this is to say, well, look, if you're terminated without cause, certainly there's different, we're going to accelerate some of your vesting so that you not. I don't want to take this down a path that doesn't need to go in this very short period of time that we have, but those are the types of things that we'd be talking about in the vesting discussion, is sort of what happens if we terminated for cause, without cause, who has the right to terminate, what is leaving the company, and with good reason, if they take investment. And then another point to make, which is when the investors come in the next round, it's likely that we're going to revisit all of these things again, because most people aren't going to write you a very large check without having some degree of confidence that you're going to continue down the path. So I think that's a short way of saying, Ben, that maybe we can get comfortable with what Don proposed, and that they seem to be comfortable with, because we might get a little bit more comfort once in the next year, when this converts into actual equity, that someone else is going to probably layer on a new vesting schedule on top of whatever we've already negotiated, to be honest. So just something to keep in mind. Back to our main show.
All right. So I guess that's acceptable to us then, the 1/3 vesting immediately, and then the rest as scheduled over that time period.
Over a 3-year period.
Yes.
Okay, cool. Is my team okay with it?
Yeah, that's perfect.
Yeah,
Cool.
I agree.
Cool. Okay. There were a couple other things we wanted to mention, sort of in that vein?
Yeah. The next term I want to discuss is on the non-compete. Right now it stands at 3 years. We're sort of looking to see if we can amend that into 18 months.
How about 2 years?
Anthony, yes. Let me concur with Anthony. Anthony, are you good with 2 years?
Yeah, I think we can sit for 2 years.
All right.
Okay, our next term of negotiation is on the severance. We want after 6 months.
Which is to say, we're looking for, if we're terminated without cause, which is, again, not going to be a huge issue early, but later it may be if we lose control, then we want severance, a 6-month severance.
So this isn't something that we really discussed, frankly, because it's not something that really seems germane at this point in time. To your point about, maybe down the road, before you take money from somebody else who's in a position to terminate you, we can have a conversation around severance. But it's a little hard for us to put a place a severance package for you if we don't have any ability to terminate employment. So, again, this isn't something we really talked about, and don't necessarily think it's something appropriate to put in place when you're still in control of whether or not you're leaving. So, if, as between the two of you, we don't want any games being played with, can't remember who the minority holder is, looking at your cap table, wants to ride off into the sunset and want to provide a parting gift. So that's my thought on that one. Ben, I don't have further thoughts, but.
All right. So we don't believe that's something that should be should be changed.
So sidebar to my group, that's probably a reasonable position to take at this point, and we'll negotiate that when we get to the real money.
Okay. Anthony, you good?
Yeah, that's good for me.
Sidebar for the record, David just said I did something reasonable. I'd like that to be noted.
Yeah, really. And the worst part of it is it's actually being recorded. So that's
horrible for posterity.
Yeah, really. Can we move on to I know we're going to run out of time, but there are a couple more things I think we wanted to cover. Can we talk about period of time for this and legal fees. And let me address that because there are legal issues. We agree that we should pay your legal fees if the deal closes. We can't afford to pay your legal fees if this doesn't close for whatever reason. So we're happy to pay your legal fees subject to a cap. And we think that cap should be about $10,000 because the good news is we can do this quickly. And similarly, because as your counsel pointed out earlier in this conversation, earlier in this thing, the session, we can get to the closing really fast. So we should be able to move this December 31st to November 15th. Let's get this done in 30 days. So the exclusivity should be to November 15th is what we're suggesting. We'll be happy to pay your legal fees if it closes, capped at $10,000, and move forward on that basis.
As far as the the December 31st date and the exclusivity agreement going to that date, we would be willing to shorten that from the current roughly 90 days to 45 days with with a provision that that could be extended in 15-day increments up until the date.
With mutual agreement.
Yes.
As long as we're still working towards a transaction. So if we're all still working towards a transaction and nothing has changed materially in the terms, but we would expect that you're going to honor the exclusivity. So we're not dragging feet.
But it's mutual. So sidebar to the group. So if we're not happy with the way it's going, we don't have to extend it. Correct? So that seems okay as long as it's mutual. So it requires both parties to extend it. And 45 days is pretty close to what we had suggested. So that seems okay.
Yeah, the 45 days sounds perfect. Yeah. Yeah, the 45 days was good.
Okay.
Veronica?
Yeah, it sounds good for me.
And what about these legal fees?
We're very expensive. So
Adam is extremely expensive, so we have to recoup that.
You can, I have no
I'm
comment.
expensive. You should see what David is. Wow.
Definitely. And that's the reason Sean and Carrie are on the line. Yes. But seriously, this is a convertible debt. That's the reason we're doing this. It's relatively inexpensive, and we want to run to the finish line. And as Kit pointed out during our group meeting, which I thought was a good point, is look, we don't want money that otherwise needs to go to this business to lawyers.
Yes.
Into a soccer game. Thank you for all.
Oh, okay. Hey, good to see you, Don. Thanks for your input.
Right. So Ben, I think, assuming that we're working on form documents, the legal fees are unlikely to be much more than that, to be honest. So that's probably something you can get reasonably agree to. You can push for a little bit more if you really wanted. The main point being that you're a network of angels, so it's hard to go back to your team and cover the legal fees if they're not fully covered by the company here and everyone passing the hat. But what I would tell you on the other side is you could negotiate a flat fee for this representation, and we'll get it done to make. If this is the last point that's keeping everybody from happy hour or dinner or soccer games, we can get there by we'll fix it. How's that sound?
I agree, and I agree with what Adam just said.
And we agree that the company's not paying if we don't close the deal.
Yeah, that's
yes.
Standard. Yeah.
Cool. Okay. All right. We had one other clarification. I know we're out of time, but it was just the board seat would disappear upon the conversion, correct? It's probably just a flaw on this term sheet. Adam, you might want to fix your form. But it's not just a significant transaction, it's also on the conversion, because there wouldn't be any notes left, correct?
Ben?
Yes.
Pardon? Okay, cool. That's everything we had.
Okay, just a reminder, our next Smart Start is on how to form a company. And that's 10/19, same time. And then that's going to be followed up by a workshop where we actually pair you up with lawyers and law students who will then give you the roadmap on when you do get around to forming a company. No obligation to do it right away, but you'll then be an informed company owner.
Thanks,
Okay.
Dean.
Right.
Thank you.
Thank you, Adam and David again, and just thank you for zooming us around. And we'll see you on the 19th.
Thanks,
Kate,
Dean.
for the opportunity.
Thank you.
Thanks.